Hello, everybody. It's Thumper from Financial Options, and today we're talking about one of my favorite strategies, covered calls. This is a great strategy that you can add if you're a dividend investor, because if you're a long-term buy and hold, you can sell covered calls way out of the money, low chance of being exercised, and just collect that extra premium that you can use to buy more shares of your dividend stock. So with that said, let's get down into it and talk about how this actually works. So the option seller, or in this case, you, own 100 shares of the stock that you're going to be making this contract on. And that's what you bring to the table is those 100 shares. The buyer is bringing something called premium, and it's the cash he's going to give you in order to have the right to buy your shares at a price that you dictate in the future. So once this contract is made, he now has the right to buy 100 shares at that specified price at a certain date in the future. And you still have your 100 shares. You collect any dividends that come out during that time. You also get the premium, or the cash he gave you to secure this contract. And as we know, all contracts are just kind of marching to their demise. They have a date of expiration. And if at the date of expiration, the stock price never went above your strike price, it's considered out of the money. His contract becomes worthless. It's like you just sold him a worthless thing and you came out with that cash. You also still have your 100 shares, so you can repeat the process and sell another covered call, collect some more cash. If, however, at the date of expiration it's in the money, you still keep that premium you received, but now you have to sell the shares at the strike price that you guys set. So if the stock skyrockets way beyond, you miss out on that potential profit. But since you're a long-term buy and hold investor anyway, you wouldn't realize that profit anyway. So like the risk there, if you're a long-term holder, is very low, and you receive the cash from selling the shares, which you can use to buy more stock, establish another dividend position. You can go and buy back the stock that you sold. So that's a short summary of what this is, but I've learned best by doing. So I'm gonna go over like an example here. All right, so if you've never used the ThinkOrSwim platform, great platform. And one of the features here that I like is if you click on demand, you can change the date to some day in the past to test strategies and see how they evolve over time. So for this example, I'm going to go back in time to April 5th and pretend we're going to be selling a cover call on Microsoft. So right now, on April 5th at this time, it is selling at 246. First thing I like to do is look at the chart, look at the 1 year chart, and see what the high was. In this example, it's actually at the high, so that's not the best example, I guess. But you want to be above the 1 year high. What I would do then is go to trade, look out about a month, and I'd be eyeing for something. Well, looking at this, I probably want to stay above like 270 if I really want to make sure that I'm not going to get called away. So 270, which should be about 90%, 95% probability out of the money. So 270 is actually 89%. Since I actually don't want to be managing this position, I might go safer. Maybe even 275, 92%. Well, I can get the 280 and still collect a pretty nice premium. So in this case, I would sell the 280 strike a month out and collect about 52 cents here. We'll take the mid. So 52 cents, but since it's a contract, it's 100 times. So I'll be collecting $52. And what's neat about this is the dividend for Microsoft is only 56 cents per 100 shares, or sorry, 56 bucks for 100 shares. And right here, we're collecting 52 bucks for a 1 month hold, whereas the dividend's paying out once every well, looks like they only paid out 3 times last year. So once every 3 or 4 months. Here you can collect this 52 bucks every month in addition to the dividend you're getting. So that's pretty cool. And I'm actually gonna sell this real quick. Sell it. Confirm and send. This is the test account. So that got filled. Actually got 51 cents, so that's pretty cool. I'm gonna go ahead and move this to beyond our expiration. We had May 7th. I'm gonna say it's the day after. And we'll just take a look at the chart and see if it ever reached that point. So we sold up here and we said it's gonna have to go above 280 for me to actually fulfill that contract. It looks like in that month Microsoft actually went down. Only went down $30, but the key is it stayed below 280. Never even got anywhere near that. So in short, I just got paid $51 to just hold the stock and do nothing with it. Like that's why cover calls are awesome, and like a dividend investor should really look into doing this. Theoretically, you can do this every month and you'll collect about the same premium. Again, just kind of stick to like 95% probability out of the money, 90% if you feel more aggressive and you're okay with letting it go. And the difference as you move closer to the money, like you can see how much premium or how much money you can make. But since we're looking at dividend investors right now, stick around 95% or higher, and you probably collect about the dividend every month instead of having to wait 3 or 4 months to get it. Now, what's also neat about options is even if you're wrong and it goes through your strike price, maybe you don't really want to sell those shares at that price because maybe some tax implication. So you don't really want to sell those shares to trigger that tax event. You can roll, and to me, like rolling is like sitting there with a stick on a carrot where you just keep moving it. You move the finish line repeatedly. So as it's in the money, the buyer thinks he's gonna get those shares and make a little profit. You turn around, you buy to close the contract, you go out a month, you sell the next one, collect more credit, and you just move that finishing line further away, and the buyer has to wait even more, where this new one would have to wait more. In this scenario, when you buy to close a contract, you will most likely be paying more than you receive in the premium. If Microsoft shot up to 285, it might cost me $500 to close the contract, but then I can go out a month further, and I could probably sell the next one at the same strike for $550. So I pay $500 to get $550 and wait another month to see if the price drops below my strike price. And you can just continue doing this so you never actually have to, give up your shares and create that taxable event. There are some risks if it's a dividend stock, especially, and the extrinsic value on the contract is less than the dividend payout. There's the potential that they can exercise it early, force you to give the shares because they're trying to capture the dividend. To avoid that, you can roll the contract out further out in time and make it less profitable or actually against them to exercise that contract early. All right, so looking at the numbers, if you had 100 shares of Microsoft and it paid a dividend 4 times a year, you would have made $224 off of that position. But if you sold at options for 1 month out and you did that 12 times a year and got the same price, this is ballparking it, you would have got $612. You can make more if you go closer to the money, but for the example we did, we're saying you did that same thing. So this is a ballpark if you continually do that for the year. When you combine that, instead of making $224, you would have made $836. But dividend investors, you're reinvesting all those dividends anyway, so you want to see how many more shares do I have in that position now. If you're dripping at 224 divided by, I think the price is 160, congratulations, you got 1 share. But do it with the premium by selling option contracts that don't get exercised. You made a lot more money. You now gained 5 shares in that year instead of 1 share. So hopefully this presentation piqued your interest, because I think it's a really awesome strategy that dividend investors can use. And it's just something you might not have heard about or thought about. And if you like this idea, go out there, do some research. It might take you 10 to 40 hours to master this strategy, but then that's a strategy that you'll be employing the rest of your life, and it'll pay off. So take that time, invest, learn about it. If it's not for you, that's fine. Every investor's different. Figure out what works for you and do it. I just think this is a awesome cheat code for dividends that you should hear about, or at least be exposed to. And with all that said, if you like this content and want more of it, hit that subscribe button below and share this video. Get word out. If you have someone who and is a dividend investor, share them this video. Maybe it'll pique their interest and they might be learning how to make more money. All right. Well, thank you for watching. I'm not a financial advisor. Any information included in this video is for informational and entertainment purposes only. It is not intended to be investment advice. Please seek a licensed professional for investment, tax, or legal advice.